Dear students, welcome to today's session. Today's topic for discussion is corporate governance rating. See, for all good reasons, companies and their boards, they are searching for bragging the rights to good, better or even the best corporate governance practices, right? So here we have seen the different models of governance. We have seen how the corporate governance standards principles should be elevated, should be improved. So the increasing focus on governance that has also resulted in this new rating systems that rank on an absolute basis. It analyzes, it compares the relative corporate governance practices of companies. So why should the directors and executives care about corporate governance rating? Given the widespread media focus on corporate governance, so it is clear that bad ratings can make good press. Ratings are now being widely published. It is being licensed by the investment firms and published with their analyst reports. So as we all know, this is a very powerful tool of accountability. Corporate governance rating, we have several rating mechanisms, but this plays a powerful tool. And individual customers are rated by the specialized agencies. So you call them as credit bureaus. They provide a credit score. And this credit agency that rates their debtors on the basis of their ability to pay back their interest loan amount on time. That's what credit rating agencies are doing, right? For example, CRISIL. What is CRISIL? CRISIL stands for Credit Rating Information Services of India Limited. And CRISIL was the first credit rating agency set up in India. Now, if you see, CRISIL has become a global analytical company that rates companies, researchers, the market. It provides risk and policy advisory services to its clients. At the time of incorporation, the agency was promoted by ICICI Limited and many such financial institutions. So we have different credit rating mechanisms. Corporate governance rating is an opinion or it's a relative standing of an entity with which we need to adopt of the governance practices. It provides information to the stakeholders about the level of corporate governance practices of that particular entity. It enables the corporate entities to obtain an independent and credible assessment of the quality and extent of their corporate governance. So there is a rating process that determines the relative standing of that particular entity. Companies, they can also use the ratings as references and they can set benchmarks for further improvements. That's how the CGR works. And CGR is not a certificate on any statutory compliance, or this is not a recommendation to buy or sell the securities issued by the entity. CGR should not be construed as any direct correlation with the rating of debt instruments of the organization. So this is something where we need to understand. CGR talks about the position of your organization in which, how well you have adopted the governance practices. What are the benefits of corporate governance rating? It enables the corporate entities to obtain an independent and credible assessment of the quality and extent of their corporate governance. So here it works keeping it in mind that The CGR process involves the perusal of various documents like agenda papers, minutes of board, the documents filed by the bank, the regulatory bodies, minutes of the annual general meeting, and any other meeting that involves the top management, let it be CEO, independent directors, whole-time directors, internal auditors. So, when they go for the corporate governance rating mechanism, they'll be having the key points. The board composition and functioning, the ownership structure, quality of MIS, Management Information System, shareholders profile, disclosure and transparency, the financial prudence, and then statutory and regulatory compliance. Corporate governance ratings have been introduced and implemented in countries to judge the extent of compliance of corporate governance principles. The rating agencies, let it be international or national, they have worked on a suitable rating methodology on evaluating the adherence of corporate governance principles by the companies. So the international rating mechanisms are engaged in providing such services. In Indian context, if you see, you have CRISIL, ICRA, CARE ratings, they are involved in the rating mechanisms. In global arena, you can see the GMI rating, ISS, Institutional Shareholder Services. So they have involved in this one. So each organization has relied on certain corporate governance principles, and according to that they have devised the rating as well. As we have seen several principles of corporate governance, so the need for adhering to such principles in organizations, it has to be well organized, and the rating and research has to be put it in place in a proper mechanism, and to measure and interpret how the norms are complied with. So this is an independent system and it has to comply with the standardized norms. Norms may vary from companies' ownership structure, rights of the owners, of the control and management procedures. So that may vary. But the view on the relative standing of an entity. So how will you justify the corporate governance rating mechanism? So here I am going to discuss on 5 parameters. First, it provides information to various stakeholders about the level of corporate governance practices. So with regard to CGR, it will give information to the stakeholders about the level of corporate governance practices. Second, it enables corporates to obtain an independent and credible assessment of the quality and extent of their adherence to the governance standards. Third, the rating process determines the relative standing of the organization, with the best practices followed in the domestic as well as international arena. Fourth, organizations, they can deploy the CG ratings as reference and they can set benchmarks for their future further improvements as well. The fifth, investors, they are getting benefited as they are able to differentiate companies based on what? Based on such rating mechanisms, right? So this is how organizations or the rating mechanism works, and that gives information. CRISIL, if you see, they are relating to the CG ratings for the governance and value creation. The rating provides a clear picture on existing governance norms and it helps in comparing and benchmarking with the best practices and functions. So it has become a powerful self-improvement as well as self-assessment tool. corporate governance rating agencies, they have methodologies. If you ask the international rating mechanisms like GMI ratings, which is formed in 2010 through the merger of 3 independent rating institutions. One is Governance Metric International, second Corporate Library, third Audit Integrity. So these 3 independent rating institutions have been merged to form the GMI rating. Okay. These institutions were involved in governance rating business. So what were their focus points are? Accountability, financial disclosure, internal control, executive compensation, market for control, a reputational and socially responsible investment issues, and shareholder right. So these 3 independent entities form together to form the GMI rating, and they have focused on all these points. And GMI rating provides a better coverage of governance risks to institutional investors. GMI rating is also specialized in 2 types of rating. One is ESG rating and another one is AGR rating. What is ESG? E stands for environmental, S is social, and G is governance. So ESG rating evaluates the sustainable investment value of public companies. And the ESG ratings are based on 150 key risk factors, and that has been organized into 6 categories to ensure the consistency, transparency, and the structural integrity. So how will you express the ratings? You are expressing the ratings in 2 forms. See, already the GMI rating is expressed in 2 different types. One is ESG and another one is AGR. Under ESG, you have 150 key risk factors which have been categorized into 6, so that you will have a good, transparent, consistent and structural integrity. And these ratings are expressed in 2 forms: percentile scores ranging from 1 to 100 and as a letter grade from A to F based on the percentile score. Now what's the other one I said? AGR, Accounting and Governance Risk Rating Scores, that are based on some risk factors organized into categories like revenue recognition, expense recognition, asset liability valuation, high risk events. So these are the major criteria of AGR rating, Accounting and Governance Risk. Now the AGR ratings, it helps the investors and public in predicting the adverse events like litigation or enforcement action. So the investors, what they do is that they integrate the GMI's AGR rating into their financial model. So once after integration, it will be easy for them to identify and mitigate the portfolio risks. So GMI ratings publish their ESG ratings on 6,400 companies worldwide, while the AGR ratings are published across 29,000 companies. As you look into this particular picture, we have ESG ratings component structure. Look at the structure, whatever I have discussed now. So how far the key metrics are being taken to come out with such a infrastructure. Corporate governance rating is basically the score which indicates the risk assessment of the corporate firms, and it has been done by an independent company. So it is an opinion where the relative standing of a particular entity or whatever with regard to the adoption of corporate governance practices. There might be a question in your mind, why corporate governance rating is required. We use this mainly for providing information to the stakeholders. That's the first objective. Second is that for reference and to set benchmarks for further improvements, you need CGR. Third, it provides independent and credible assessment of quality and extent of their corporate governance. So these are the objectives why we need the CGR. And what are the different assessment criteria we have? It differs from different ratings irrespective of the company, the agencies who come out with the framework of the rating mechanism. They are not following any uniform set of criteria. It differs. But the board parameters of the matrix that remain the same. So the parameters like audit board structure, shareholders' rights and compensation, accounting, ownership and control. So these are all the parameters that is quite common among different rating mechanisms. See why this rating mechanism is required. Already I have given you few case studies based on that. One such example where the corporate governance has failed is this Enron example, where those at the top allowed a culture to flourish in which secrecy, rule breaking, some fraudulent behavior were acceptable. So it appears that the performance incentives that created a climate where employees sought to generate profit at the expense of the company's stated standards of ethics and governance and strategic goals as well. Enron had all the structures and mechanisms for good corporate governance. In addition, it had a corporate social responsibility task force as well, and a code of conduct on human rights, security, social investment and public engagement. But yet no one followed the code. The board of directors, they allowed the management openly to violate the code. Particularly when they allowed the CFO, the Chief Financial Officer, to serve in the special purpose entities. Audit committee allowed to suspect accounting practices and made no attempt to examine the illegal transactions. The auditors failed to prevent questionable accounting. So this is one of the worst governance failures, and that has led to the Enron fiasco as well. Then comes Volkswagen scandal. It's also a corporate governance failure because it provides evidence of the fact that the company's culture or the company's corporate structure, in this case it is clear that the system of checks and balance seem to be defective. Several players are responsible for such scandal. First of all, the managers of the company, they failed to act in the shareholders' interest. As I already said in the introductory session of our course, right? Why we have governance? For the interest of shareholders. Instead, they acted in their own interest of enhancing their personal wealth. They have started to increase short-term profitability of the company. They have promoted the increase in stock prices so that they would have personally benefited in terms of compensations. Second, the shareholders failed to exercise the appropriate amount of control and oversight over the company's operations. Shareholders, they have the ultimate control over the company's management. through their boards in general meetings, but they don't have any direct management power. They still have the most important role in the company's decision making. Then the most important damage to the company's concern is its reputation. See, environment concerns, they used to represent as an important element of differentiation for the company's image. So what happened with this scandal is that it has undermined the credibility of Volkswagen, and that has to face some serious repercussions in the future of the business as well. And if you take the Punjab National scam, it was also a corporate governance failure. As we have discussed in the necessary things that a company should follow, here they have completely destroyed the structure. So in the Punjab National Bank board, it had 11 members, with one of them as a part-timer. In fact, the website of the bank doesn't clarify the category into which these directors fall. So what happened incidentally is that the part-timer, who is the non-official director, who is supposed to play all the important roles in the audit committee. The board is having 1/3 of the members, hence there is a constructive challenge. They also have a crucial role to play in scrutinizing the performance of management systems. Looking at the corporate governance and the annual reports of PNB, we can easily find that the audit committee is not headed by a person who is having accounts or finance background or expertise. And the other members also seem to be no experts in accounting. So this audit committee is having another critical element of governance, where the PNB has been willing to compromise with that. So all these things have made the need for good corporate governance. Even that has been felt in our own country, where various agencies, they started to rate the corporates in order to help the stakeholders from the opinion about the governance practices in the organization. CRISIL's governance and value creation rating. See, CRISIL's GVC mainly is to assess the impact of corporate governance practices of a company on all the stakeholders, and it indicates the capability of the entity with respect to wealth creation for the stakeholders, while they can also adopt the sound corporate governance practices. The corporate credit rating, it's an opinion of an independent agency, right, regarding the likelihood that a corporation will fully meet its financial obligations. A company's corporate credit rating indicates what? The relative ability to pay its creditors, and it gives an idea to the investors of how the company's debt security should be priced. What are the benefits of a credit rating mechanism is that it lowers the cost of borrowing. Rating acts as a marketing tool, because company with a rated instrument, they improve their own image. They avail the rating as a marketing tool to create a better image in dealing with its customers. They feel confident in the products manufactured by the firms who carry higher rating. So this is somewhere creates a marketing mechanism, and this is also acts as a motivation for growth. Rating provides motivation to the company for growth. So as the promoters, they feel confident in their own efforts and are encouraged to undertake expansion of their operations or new projects. So with better image created through higher credit rating, the company can mobilize funds from public and institutions or banks from self-assessment of its own status. So these are all the things where it is very beneficial, by having a corporate governance rating mechanism. Let us now look at ICRA's corporate governance rating methodology. So I am going to talk about the methodology, the conceptual base, the parameters, the assessment criteria that have been involved in this particular rating mechanism. ICRA's corporate governance rating, it seeks to evaluate a company's business conduct and practices and the quality of its disclosure standards in terms of fairness and transparency. That too from the perspective of the financial stakeholders. The corporate governance practices is very much prevalent in an organization that reflects the distribution of rights and responsibilities among different participants. So can it be management or shareholders or financial stakeholders? There is a conceptual base for this. OECD has defined this as a system by which the business corporations are directed and controlled, right? So here we have the distribution of rights and responsibilities among different participants. Can it be board or managers or shareholders or stakeholders as well? If you look at this particular diagram, the framework gives you an understanding on the interaction among the different participants in the company who are being rated. There is an interrelationship between them. Can it be with the executive management led by the CEO or the board of directors or the shareholders? You can easily sense that there is a mutual interaction and interrelationship among these different elements. So how this framework is designed? How we are going to analyze? So what are the key variables that we come to conclusion while arriving at the CGR? One is ownership structure. Second, governance structure and management processes. Third, board structure and processes. Fourth, stakeholder relationship. Fifth, transparency and disclosure. Sixth, financial discipline. And the last one is ethical practices. So these are all the key variables that has been analyzed using the ICRA's framework. Under ownership structure, what will be the key issues which they take it into consideration while rating? So if there is a corporation, their ownership structure is assessed based on these issues. The first is extent to which the dominant shareholders are easily identifiable. Then, extent of cross-holdings that may compromise the minority interest. Extent of shareholding by promoter group. Extent of institutional shareholding. And finally, pattern of retail shareholding. As a transparent ownership structure where the key shareholders are easily identifiable and the absence of opaque cross-holdings are positives from ICRA's CGR perspective. So, we focus on, in ICRA's framework, we focus on the major two issues, and that has been a great unique feature with this particular rating mechanism. When talking about governance structure and management processes, the focus of ICRA's analysis is on the decision-making process, followed by which within the company being rated. And there is a quality, then a nature of information that is presented in the book. ICRA believes that for a company to be able to respond swiftly to change, how they are being very much reactive to change in today's dynamic business environment, line managers led by the CEO have to be given enough power so that they can make good decisions in the most appropriate manner. And it has to ensure that the powers are exercised in accordance with established procedures and that they are in the harmony with the broad policy guidelines and strategic objectives formulated by the board. So the governance structure and the management process should be in such a way. So their focus when they analyze about a particular firm, they want the nature of information, they want the quality of the process to be in such a way. Who is more proactive to change or who is reactive to change at the end. Whether they are able to make decisions in an ethical, appropriate manner, how the powers are exercised, whether that's a line manager, how we are delegating the work, how the harmonious culture is in the work environment. So this is what they focus on. So the major key issues here, they talk about the extent to which the clearly defined governance arrangements are present and followed. That matters, right? Second, the appropriateness of the decision making process, and then the quality of information submitted to the board. So these major three issues the ICRA rating mechanism focuses on. Now coming to board structure and processes. So the key board functions of any organization for that matter: approving, monitoring and reviewing the strategy proposed by the executive management. They evaluate the performance of the top management. They ensure compliance with legal and statutory requirements. So what you call that as the control function of the board. The final one is balancing the rights and concerns of shareholders and other stakeholders. So a competent board of directors free of conflict of interest, they can help protect the stakeholders' interest as well. They are ensuring compliance with the prevailing laws of the land. They provide strategic guidance to the executive management. So the full board may not be able to provide or meet very frequently to devote its close attention to the business, but some of the board functionings are performed through specially constituted board committees. So here in terms of the structural aspects, first is the size of the board. That's the first criteria to look upon. Then the proportion of the independent directors. Then other directorships held by the independent director. Then the mix of skill set with which the independent directors bring to the board. So structural aspects, the four key criteria are focused on. Then comes the effectiveness of the board. So first is the frequency of the board meetings, how many times you meet. Attendance track record of directors. Quality of agenda papers and the extent to which they are circulated in advance so that they come prepared and have a good, productive, insightful discussion. Then quality of presentations made to the board. Then the board's role in approving strategy proposed by the executive management. Deliberations related to major investments or capital expenditure or anything related to party transactions. And then board's role in determining the executive compensation. So these are all the major attributes. We focus on the effectiveness of the board. Functioning of board committees. Among the board committees, the audit committee is clearly the most important in terms of scope of activities. A properly functioning audit committee has the potential to improve the quality of financial reporting, strengthen the position of auditors, ensure that effective internal audit and internal control are in place. So in the functioning of board committees, we talk about the composition, we talk about the expertise, we talk about the role in the appointment of the statutory auditors as well. Already we discussed this in clause 49 of the listing agreement. It doesn't make it mandatory for a company to set up other board level committees like a remuneration committee, nomination committee. But ICRA believes that issues like established and transparent criteria for selecting independent directors, for determining directors' remuneration, or to ensure that the directors and senior management remuneration is aligned with the company's performance. Let them all be the indicators at the end of the day. Financial discipline matters. See, the ultimate objective of corporate governance is to create and maximize the shareholder value. While the actual shareholder value generated by a company may be dependent on a number of factors that are beyond the control of its management. But ICRA believes that the maintenance of certain level of discipline in the conduct of business operation has an important role to play. You may take business segments in which the company operates, or the extent of reliance in debt financing, number of subsidiaries, number of transactions within subsidiaries. So these are all the ways in which ICRA works. ICRA believes that this rating service would assist the corporates to project an objective, a credible opinion on the quality of their corporate governance practices, on their responsiveness in addressing the interests of the financial stakeholders. Several empirical research shows that corporate governance is one of the important factors influencing corporate valuations. Superior governance practices may also facilitate accessing fresh capital. So that is always a favorable impact on cost of capital. ICRA CGR is not an indicator of statutory compliance. Higher CGR may improve the comfort that statutory authorities or regulators may have with the rated company. It enables the company's benchmark itself against the best practices. So it provides a greater opportunity for improvement. So this is how ICRA's rating mechanism works. Can it be ethical practices or financial discipline with regard to transparency and disclosure? See, when you talk about transparency and disclosure, starts with accounting quality. The disclosure and transactions with the subsidiaries, their associates, any additional information to the stakeholders. So quality matters everywhere. So as we have discussed in the ICRA's credit rating mechanism, the key focus was given on the ownership structure, the governance structure and management processes, board structure and processes, stakeholder relationship, transparency and disclosure, financial discipline and ethical practices. These are all the key variables ICRA's framework focuses on when we talk about corporate governance rating.